Hello, this is Dr. S. Baranidharan from St. Joseph College, Kannur. So, here we are going to talk about financial management. Before going to the financial management, we should know the concept called finance. Finance is the important parameter for any business which deals with all kind of business activities in the world. Generally, finance is the core player of running the business. In every businessman knows that finance is the lifeblood of business. It is electricity for a machine. Before going to the financial management, we should know about something called finance. Finance. Finance is directly deals with business activities. Generally, it talks about profit, the margin of business, the company securities, equities, and bank transactions activity, bank, and it's all about talks figures. So generally, business finance deals with all kind of parameters in the organization. What do you mean by finance? Finance is the study of how people and business have evaluated investment and raise capital to fund them. There are two parameters here clearly explains what is finance. So here finance help people also business to evaluate their investment and raise capital to fund them for making the profit or returns. What do you mean by business financing? Business financing is the business activity which concerns with the acquisition and conservation of capital fund in meeting the financial needs and overall objective of business enterprises. This para clearly explains that two important concepts here. It is a business activity which is the concern of acquisition and conversions of capital fund. Finance conversions of capital funds to meet their business needs. The meaning of finance. Finance may be defined as the art and science of managing fund. It includes financial service and financial instruments. The concept of finance, it may be called capital, fund, money, and amount. The financial service are called banking, mutual fund companies, insurance companies, stockbroking companies, and provident fund companies, and etc. Financial instruments are called debts, bonds, equities, and other kind of financial instruments are there in capital market. The next we would like to see that the four important parameters which is more important concepts. The first one is planning, raising, investing, and monitoring the finance. First, we need to procure the fund. Where you need to procure the fund and where you need to raise the fund. These two important concepts are more important. The second one is investing, allocation of fund, and fourth one is monitoring of fund. Procuring, allocations, and monitoring of fund. The next one is features of finance. There are 5 important features in finance. First one is need to seek the investment opportunities, and you should know the profitability opportunities and obtain mix of funds which you call the equity, debts, bonds, and other investments. The system internal controls, so internal finance flow, we call cash flow, fund flow concepts. The fifth one is future decision making. These are the 5 key important factors determines the features of finance activity of any business. The next one we call the objectives of business and characteristics of business. The two major objectives of business finance is profit maximization and wealth maximization. The others we called as in characteristics of finance: loss avoidance, sales profit growth, product quality improvement, customer service relationship, and other things. The financial activity: raising the funds, investing the funds, objective oriented, types of funds, relationship with other departments, dynamic in natures, requiring proper planning and controlling, managing finances, art and science, legal requirements, important factors of business management. These are the characteristics of the finance. We should know all the things what we do determines the financial activity of any business. The core of business finance is categorized into two parts: source of funds and another one use of funds. The source of fund we called source of assets, and use of funds we call management of assets. We should know the clear meaning of source of asset and management of assets. The source of assets, we know that the assets we called as funds, which is receiving from outside the organizations and members of organizations. So the funds has been categorized into again two parts. It's segregated in two parts. One we called as ownership resources, another one we called as creditorship resources. The ownership resources we called internal fees, reserve, depreciations, and external share capital. And creditor ownership is short-term loans, long-term loans, debentures, public deposits, trade credit. When it comes to management of assets, we categorized into again the management of assets categorized into two parts: management of circulating assets and management of fixed assets. The management of fixed asset we called as owing, renting, leasing, and other things, and circulating we called keeping, then removing, and accelerating, like that. So next one is when it comes to capital of finance, the equity finance, we called categorized into two parts. One is called equity finance and debt finance. Equity finance and debt finance. The equity finance, which called as an equity shares, the funds has been raised through equity securities. Another one is method to raise the fund we called as debt finance. When we early slides we have seen the ownership funds. That ownership fund has been categorized equity and debts, the two important securities which helps to raise the capital in the business, particularly equity finance and debt finance. The two are more leverage of any capital of business. And when we talk about equity finance and debt finance, it is a more big parameter we see in the next video. Next, principles of management. Principles of management are categorized into 6 parts. The first one is a risk return trade-off. Second one is time value of money. Third one is leverage. Fourth one is liquidity and profitability. Liquidity versus profitability, and matching principles, portfolio effect, and valuation. These 6 principles are ruling or determining the directions of financial management, which helps to make efficiency of managing the finance in the organization. If any one of these absence in principles, it would cause the financial management activity in business. So these 6 are key principles of financial management. The next one is interdisciplinary nature of financial management. The financial management is a deal with all kind of sectors. It deals with any kind of sectors as well as it deals with any kind of discipline which you are going to study: psychology, financial market, foreign exchange market, taxation, law, auditing, economics, derivatives and risk management, financial and management accounting, and mathematics, statistics, and operation research. These are the interdisciplinary nature of financial management, which is when we do financial management, these all the things will be included in financial management. It all interrelated, connected with the financial management. So when we going to study more about financial management, you're going to interrelate all the interdisciplinary will support the financial management activities to make better financial study in the terms of corporate finance. The next one which you're going to study is functions of financial management. Functions of financial management. There are 6 functions of financial management. The first one is estimate required capital. Second one is determine capital structure. Third one, evaluate and select the source of cap fund. And fourth one, allocate and control funds. Fifth one, distribute profit and surplus or dividend. Then last one, monitoring the financial activity. These six are the core functions of financial management. We should know the requirement, what is the exact requirement of capital, then determine the capital structure, how much equity you going to possess, how much debt you going to possess, which we called capital structure. Then I need to evaluate the source of fund, where you going to collect these funds and select the source particularly. The next one, allocate the funds and control the funds, when you need to allocate, where the financial needs are required. We need to allocate, the company has to allocate the funds to the particular needs. Then after profit, they have to distribute the profits to the equity holder and make surplus, we call reserves, like that. The next one, we need to monitoring the financial activities of the organization of business. These six are more important functions of financial management. The next one we're going to see, they called financial management, maximization of share value. How are you going to maximize the maximization of share values? Through financial decisions. The financial decision has been categorized into four parts: investment decision, liquidity management, financing decisions, dividend decisions. These four will help the business activity and which makes the financial decisions. When you talk about investment decisions, we call risk and returns. We talk about risk and returns. The two parameters are default in any business, which helps the financial activities. So investment decisions, liquidity management, financial decisions and dividend decisions are important in financial management parameters. The goal of the firm: maximizing the shareholder wealth and value of the firm. In earlier we talked about two major objectives of financial management: profit maximization and wealth maximization. So here we talk about the wealth as well as the profit maximizations. So when financial decisions, dividend decisions and investment decisions are here. When we call the investment decisions, there are two types of investments: are the long-term investment, short-term investments. The long-term investment